Your credit profile determines whether you get approved for a mortgage, the interest rate you'll pay, and more. And today I'm going to show you 10 straightforward and simple ways that you can improve your credit profile and save tens of thousands of dollars. I've personally helped buyers lower their interest rates from 0.5% to 1.5% using these exact steps, saving them $60,000 to $180,000 over the life of their loan. And by the end of this video, you'll know exactly how to do the same. So let's jump right in. Step number 1, pull the right credit report. Don't use free apps like Credit Karma because they don't use the same scoring system that lenders use. Mortgage lenders use FICO 2, 4, and 5, which aren't shown on any free app. You can buy those exact versions at myfico.com for around $60, but you don't actually need to. Since you'll need a lender to issue a pre-approval anyway, just let that lender pull your credit for free. Their report automatically includes the same 3 scores, and they'll base your approval on the middle score. Ask them to share a copy so you can save the $60 and review it for high utilization, errors, or old collections. We'll review exactly what high utilization is and ways to deal with it in this video, so don't worry. Step number 2, pay down credit card debts aggressively. Your credit utilization is simply the total of all your lines of credit balances divided by the total of all your limits, and it's one of the most important parts of your score. If you're using half of your available credit, lenders see that you might be close to tapping out your credit, which makes you more risky as a borrower. If you drop that from 50% to 30%, your credit score could go up by 20 points. If you drop it to 10%, you might gain 40 points or more. Aim to bring down your balances so that you're using 10% or less of your available credit. And if you can't get it that low, try to get it to at least below 30%. If you can do that, you can raise your credit score dramatically. And if you don't have the cash to pay down your balances, don't worry. There's another way that you can bring down your utilization rate that we'll cover in step 9. You can also do a loan consolidation with a personal loan. This will help your utilization rate because you'll be moving your credit card balances to a term loan. Just make sure your monthly payment is comparable to your old payments so you don't raise your debt to income ratio. Step number 3, set up auto pay for everything. This one's super easy and something everyone should do. Your payment history makes up the largest part of your credit score. One late payment can slash your score by up to 100 points and be looked at by mortgage underwriters as a major red flag. Auto pay through each lender's own portal, not your bank's bill pay, so that way the payments post instantly. This will save you if you ever forget to make a payment on time. Step number 4, don't close old credit cards. Your credit age matters. A long history tells lenders that you can manage credit responsibly over time. And when you close an old card, 2 bad things happen. First, you shorten your average credit history, and second, you raise your utilization rate by reducing total available credit. Even if you don't use an old card, just keep it open. Step number 5, beware of co-signing a loan. If a friend asks you to co-sign a loan and you want to help, just keep in mind that that debt counts as your debt too. Even if they make every payment on time, it still raises your debt to income ratio, and as a result, it will directly reduce the amount of the loan that you will qualify for. Once you're listed, you can't simply remove yourself as a cosigner. The only real fix is to ask the borrower to refinance the loan entirely into their own name, which they may not qualify to do. Before you cosign for anyone, remember that debt is indistinguishable from your debt to lenders. Step number 6. Handle credit disputes early. If there's an error on your credit reports, like a paid collection still marked as open, you'll need to dispute it with each credit bureau individually. Each has up to 45 days to investigate, but here's the key. Wait 3 to 6 months after the dispute closes before you apply for a mortgage. Why? Because during that time, your report may show pending investigation, which can freeze your file or delay your approval. So handle all disputes first. Let the results be reflected fully in your credit scores and then apply. Step number 7, know the mortgage credit score tiers. Let's start with the top tier so you see the impact that each level has on the interest rate you'll pay. A score of 740 or higher qualifies you for the lowest interest rates and fees. For a score between 680 and 739, your rate will typically be about 0.5% higher. And from 620 to 679, it'll usually be about 1% higher. And scores below 620 can push rates roughly 1.5% higher and limit you to certain programs like FHA. In dollars and cents, on a $500,000 loan, that 1.5% difference in rate will cost you $480 more per month and $180,000 in extra interest over the life of a 30-year loan. So you want to make whatever improvements you can. Even a small increase from 660 to 700 could raise you into the next tier, lowering your rate by about 0.5% and saving you nearly $60,000 over the life of the loan. Think of 740 as your goal. Everything you do on this checklist is designed to push you closer to that level. Step number 8. Don't open any new loans or leases. I've seen this one trip up so many buyers. Don't take out any new loans or leases until after you close on your new house. Because let's say you lease a new car. That will increase your debt to income ratio. And now when your lender repulls your credit before closing, you don't qualify for the same loan amount and you can lose the house and maybe your earnest money deposit. So the rule is, from the moment you start the mortgage process until you close, don't open new credit accounts. If you absolutely need a car, pay cash, or if you can't do that, wait until after you close on the new home. Step number 9, ask for a credit limit increase, but don't use it. This is one of the fastest ways to improve your utilization ratio without paying down any of your balances. Call your credit card companies or apply online to request a higher limit for all of your credit cards and lines of credit. For example, if your card has a $3,000 limit and you owe $1,500, you have a 50% utilization ratio. If your credit card company raises your limit to $6,000, your utilization instantly drops to 25% and your score increases as a result without you paying down any of your balances. Just of course, don't spend more, otherwise it'll defeat the purpose. Step number 10, build credit with a secured card if needed. If you're just starting out or rebuilding your credit after a rough patch, a secured card is the best way to get started building your credit. Here's how it works. Go to your bank and deposit a small amount in a savings account like $500, and that becomes your credit limit on your new secured credit card. That savings deposit is locked while your card is open. Use your card at least once per month and pay it off in full every month. Within 3 months, you'll often see a 0.25% jump in your score. Within 6 months, you'll probably be up around 0.5%. And after 12 months, you'll usually be in the high 600s, which is high enough for most conventional loans. So there you have it. This is your 10-step roadmap to stronger credit, lower rates, and home ownership. Invest a little time into this process and it'll pay you back for decades. If you found this helpful, subscribe for more first-time home videos like this released every Friday at 5 p.m. And if you have any questions about the pre-approval or purchase process, reach out anytime. I'm always happy to help. My contact information is in the description. Thanks for watching and I'll see you in the next one.